Welcome, everyone, to the Grand Wealth Management third quarter investment review. Lots happened in the third quarter, as usual. Really good performance numbers, but I want to start with a couple trivia questions just to kind of see
Oh boy. Okay.
your reaction. So, first one, talking about market highs, would you guess there were over or under 50 market highs so far this year?
Just this year in 2025.
Yep, just this year.
I would guess over 50.
Well, you're wrong.
Oh,
Only 28.
okay.
But your guess is right for last year because there were actually 57 market highs last year.
There we go.
And so in total, between last year and this year, we're at 85 in total.
So average it out as pretty close.
Right. Couple more. Over under 5% earnings growth for corporations in the last quarter.
Over under 5% just this quarter. I'm going to go just over.
You're right. So it was about 10% earnings growth,
Okay.
which is pretty good.
Yep.
And the last one, over under 20% of AI spending projected for the next year.
You mean growth in AI spending?
Yeah. Yep.
Next year? Under. I'm going to take the surprise.
So you're going to be wrong. It's actually about 33%.
Projected growth in AI spending
Yep.
next year. Okay.
So just kind of set the stage there a little bit. We've seen good performance. It's been backed up by some good growth numbers on the corporate earnings side.
Yep.
And expected continued spending through AI. And, one of the questions that I think we'll get to is just, what do you do when it feels almost too good to be true when you're an investor? Because we've had a really good run this year, followed by two really good years in 2023 and 2024. So we'll get into this, but maybe if you could just kind of kick us off with the quarterly performance numbers.
Sure. So in the third quarter alone, U.S. stocks returned just a little bit over 8%, looking at the Russell 3000 as the index. The international developed markets, so just for the audience thinking, Europe, Australia, Japan, some of those more developed economies, Canada, 5.3% or thereabouts. And the emerging markets, actually, I should give you trivia, but the emerging markets led the way with a 10.64% return just in the third quarter.
Wow.
So one thing it would be great if you could unpack a little bit is what was the driver of that really solid performance? Because if you look across the board there, you're looking at, annualized returns between 20 and 40%, depending on the aggregate that you're looking at. So it was a very strong quarter. What was kind of driving that performance?
Yeah, so when I have looked at what has driven performance, one of the things that rose to the top was corporate earnings. So we've seen really strong corporate earnings growth this year, up around that kind of 10% mark. When corporate earnings grow, the market increases the valuation that they're pricing in for these companies because they are saying, well, if the earnings are growing faster than maybe we expected, the value of this future profit stream is going to be greater. The value of that company is going to be greater. And so you kind of get this feedback loop almost. 80% of companies, looking back to Q2 now, but 80% of S&P 500 companies beat their earnings expectations, which is above the average of about 60%. So it's not just AI names. It's not just those biggest companies, but we're seeing a pretty good wide range of solid earnings in the S&P 500.
That is something that you've started to hear more about is while the marquee names like NVIDIA or Microsoft or TSM, those are the ones that spring to mind when you talk about AI. The build out of AI actually has driven performance in some very unexpected places, like HAT, for example, right? A big industrial manufacturer, because there's a very real world thing that needs to get built out as all of these data centers are springing up. So it's not just the tech names. You're seeing some broadening, and not just driven by AI, but it's good to see that broadening out of performance to companies outside of those Magnificent Seven or the top 10 companies in the S&P 500. That said, what are we seeing in terms of concentration of the S&P 500 among those top companies. That's been kind of an emerging theme that people have talked about is, is it getting too concentrated amongst those big names? Kind of where do we stand on that? And how does the grand wealth approach kind of help to mitigate some of the concentration happening there?
So I don't have the exact number, but I think that if you're looking at the top, maybe it's between 7 and 10 names in the S&P 500.
Yep.
We're looking at between 35 to 40% of the index being made up of those companies. Mm-hmm. And so if you're just investing in an S&P 500 index fund, if you have $1 million in that fund, 400,000 of it is in 7 to 10 different companies only, which is a significant concentration, I think, that we've seen relative to history. The way that we handle that is really using funds that are more broadly diversified. So we focus on using US-based funds that invest in more aligned with the Russell 3000 index. So there are about 3,000 companies in that index. And then, we focus on incorporating factors that are predictive of higher expected returns. That's including value companies, smaller companies, and companies that have higher profits.
So diversification really is what it boils down to, is the way to mitigate some of that concentration. And it doesn't just happen by accident. Looking back at the last 3 years or so, in 2023, U.S. stocks returned 26%, international developed about 18%, just under 10% for emerging. In 2024, the U.S. again really outpaced, about 24% return, just under 4% for international developed, 7.5% for emerging.
Okay.
So the setup coming into 2025 was that the U.S. was really dominating,
right?
Positive.
Why invest elsewhere?
And we saw that, right, in the numbers that we look at, that professional money managers and individual investors alike had started to concentrate more and more and more into the U.S. market, whether it was just naturally or intentionally. So the setup coming into 2025 was really, really strong outperformance from the U.S. And then when we look at year to date, 14.4% returns for the U.S., which is good, 25.1% for international developed, and 27.5% for emerging.
Wow.
And the really interesting thing is when you then step back and you look at the last 3 years, you would have thought, 2 years of strong outperformance from the U.S., the 3-year number is going to be way better than the internationals, but it's interesting to see how much it's kind of evened out, with the U.S. returning around 24%, international developed around 22%, and emerging about 18.5%.
Wow.
So when you take that 3-year time horizon, it's interesting to see how it's all come at different times, but over a 3-year time span, it's evened out.
Right.
So
that's exactly what diversification is supposed to do, right? Yep, it's give you different returns at different times, but overall give you similar or better result with less volatility within your overall portfolio.
But to get that, you've got to stick to the target allocation, right? You can't deviate from the plan, jump around and chase performance in whatever part of the market, whether it's a geography or whether it's a specific sector like AI or technology. Just jumping around and chasing that. Past does not predict future.
Yeah. And I guess another question too is, has all of that, in the US we've seen that really good return driven by NVIDIA, Microsoft, Alphabet, those sort of AI tech names. Is that the case elsewhere too? Are we seeing, if there are AI tech names in Europe or Japan or China or Taiwan, are those driving the growth outside the US, or is there something else?
It's a great question. And it, again, goes to the diversification, because it's not just that it's a different geography. And so it's different tech companies in Europe that are, also pursuing AI, and that's driving the growth.
Yeah.
When you look at Europe in particular, the defense and aerospace industry has just taken off, and that's been really a big driver of the performance over there.
And that's probably due to
of course, due to the conflict in Ukraine and some of the stance that the U.S. has taken, kind of backing off of the NATO support and encouraging European countries to invest more. And sometimes in India, for example, it's just demographics. where you've got
Hmm.
this growing middle class. They're starting to have more money, more disposable money to spend, and they're spending it. That's driving consumption, and that's improving the economy and earnings for companies in India. So that's kind of completely unrelated, right?
I guess the natural thing that kind of comes to my mind is, and I think we've seen the headlines on this too, but the question is, are we in a bubble? We've seen really good performance the last 3 years. It's been a strong bull market, but there are kind of reminders of maybe this is an early 2000s situation with the dot-com bubble. What are your thoughts on how you think about whether or not we're in a bubble and what decisions that might lead you to make?
Jeff from our team, our owner, right? He always likes to say we don't have a crystal ball, and that's true. We can make observations, but obviously we don't know exactly how things are going to play out.
Yeah.
There's real spending, like you
Yep.
pointed out, happening
Yep.
right now.
And
I think,
profits.
yeah, there's real spending, there's real profits. I think over $1 trillion is being invested or have been invested over the last 2 years by
Mhm.
those major tech companies doing the build out of infrastructure to support AI and all of the use of AI by companies and by individuals. But even as pervasive as AI might seem, I believe it's still only about 10% of companies that have implemented AI
Yep.
within their own company. So that tells you that in terms of who's going to be buying or paying for this service,
Yep.
there still is a lot of additional room to grow there.
Right.
Now, that said, if the productivity gains that I think we all want to see from AI, right? You want it to make people faster at their jobs,
Yep.
able to do
Elevate.
more productive than they
Hmm.
were. And you're starting to hear some complainings from companies that have implemented AI that maybe they're not seeing the boost that they expected.
Yeah.
And some of that might be growing pains, right? Learning new
Yep.
technology is always a challenge and where it's going to fit best. But that is, a bit concerning if it plays out that there's maybe not as great of an application or as
Right.
big of gains for companies by rolling out AI within their company. Then, you might see a bit of a slowdown in consumption, and then that drives a
Hmm.
slowdown in all of that spending.
Hmm.
And there's sort of a cascading effect that could slow things down. And you'd probably see that reflected in the market.
The other thing that I think about too is, when you're in a bull market, you're hitting new market highs, and that can lead to this feeling of, are we in a bubble? But it's really a very natural part of a bull market that you're hitting new market
Mhm.
highs consistently over a 2 to 3 year period, which is about how long bull markets kind of tend to last on average. Some last longer, some a little shorter. Um, so even though we're seeing these, you know, continue this steady uptick in the market, really good performance each quarter, that doesn't necessarily mean that, oh, we're overdue for something. It is a balancing act, and it's tough mentally and emotionally to strike that balance.
I mean, it's impossible to in life or in investing
Yeah.
to avoid that feeling of when is the other shoe going to drop.
Yeah.
And I take some comfort, if you can call it that, in knowing that historically the other shoe has always dropped, right?
Sure,
There's
sure.
going to be another downturn at some point.
Hmm.
There's going to be another recession, but there have been plenty of those before.
Yeah.
Every decade or so, you tend to see these pretty dramatic pullbacks, these major events, the dot-com bubble, the 2008 financial crisis. It's happened before, but when you look at the long arc of history,
Yep.
if you go back to the 1950s or the 1920s, pick your period,
Hmm.
you still see 10 to 12% average returns for stocks.
Yep.
It's bumpy. There are some really bad years or even, a bad decade here and there.
Yep.
But by and large, if people have invested, stuck to a diversified portfolio that's intelligently allocated that fits to their risk profile, they've been rewarded by doing that
Yeah.
as long as they can sort of tolerate those bumps. So the other shoe will drop. It will happen at some point. You
Yeah.
can't just have positive returns forever. And just knowing that that's the case, accepting it, and knowing that you've got a portfolio that's set up to handle it and a plan that's set up to sort of weather that period of time where markets are down, That's really, I think, the best approach to be able to stick with your investment strategy.
Yeah, it's so tempting to just try and maneuver around these periods, but as you said, cumulatively, the pullbacks are way less than the growth periods. And uh, I feel like I see this slide every quarter, but there's always a slide that shows the damage you can do to your portfolio if you miss the best day of returns or the best month or the best year. And so you really have to be staying invested for the long term and not trying to jump in and out and chase performance or avoid pullbacks necessarily. A few things that, I think of, we acknowledge the emotions around this. We acknowledge that we don't know what's going to happen next. But what can we do to manage our investments, manage adding money to the market or taking money out that can kind of maybe alleviate the stress, the emotional concern, or the potential of just kind of bad timing.
Right.
So a couple things that come to my mind, and maybe you can comment on these, but dollar cost averaging is kind of the main one. What are your thoughts on whether you're adding money to or pulling money out?
It works both ways. And that's something that we have been, it's a natural conversation with clients when they have additional money to invest right now, when things have been so good, when it does feel like the other shoe is going to drop, is it can take some of the, emotional toll out of, is this the wrong moment? Am I investing on the top day of the market before a big pullback? To kind of land on a strategy and, look at the amount to be invested and kind of spread it out over a 6-month time period, a year time period, kind of depending on, how much is the money being invested and, what's their time horizon with it. That can take some of that anxiety out of that decision. And, even if you look back and you say, well, we were nowhere near the top and I could have had better returns if I just done it all at once at the beginning. There's a value to, being able to sleep at night. Also a value to kind of sticking with a strategy, which, if putting everything in at once is too scary and the alternative is just, well, I'm going to just sit in cash for a year, 2 years, 3 years until the next big downturn. You're better off taking some action rather than waiting for, what feels like the perfect moment. And the same thing could be said in the opposite direction. If there's a big expense, if you're going to be buying a house, if you're going to be, pulling a significant amount for paying for college expenses for kids,
or even just annual living expenses.
The annual living expenses, if you know what those are going to be and you're feeling anxious about the market, it can make sense to, plan ahead. We're going to pull money out this amount, next month, and then 3 months down the road, same amount, 6 months down the road, the same amount, and kind of in the reverse of dollar cost averaging in, kind of dollar cost average out.
Right.
Could you just talk a bit about the current setup for bonds, fixed income, kind of what we see as a near-term outlook there? Any other observations you have around the bond market and where interest rates are likely to go?
The Federal Reserve cut interest rates, short-term interest rates in the U.S. in September when they met. Their job is managing interest rates on very short-term bonds. And so the market was already pricing this in for intermediate 5, 10-year, 15, 20-year bonds. And so it was a good confirmation from the Federal Reserve that that's where the market should be headed, but it doesn't necessarily mean that their decision dictated what happened in the bond market.
Right.
So I think last quarter we had about 2% return from U.S. bonds. And so far this year, it's been around 5.5% year to date, which is actually really right in line with what we would expect. When looking at what should I expect from a bond portfolio, you look at the yield to maturity, which is sort of this blend of what is the interest rate and what is the
price you paid for the bond.
Right. We've seen this in other periods of history. There's a great slide from JP Morgan that they publish every quarter. It's kind of a dot plot, but it shows specifically that starting interest rate is a really, really good predictor of returns over the next few years.
Very strongly correlated to what the return is. Yep.
So it doesn't guarantee the return, right? Because we're still subject to fluctuations in interest rates. But at the position we are in now, right, it's more probably more likely that interest rates will go down slightly, which will help bond returns versus where we were, say, in 2021 when interest rates were really, really low and the only place they had to go was up.
Yep.
Which led to a really bad year for bonds in 2022. So I think bonds are well positioned to have good returns for the near future. And that's good news for folks who are in kind of that 60-40 balanced portfolio and relying on some income from their portfolio to meet their cash flow needs.
Yep. And right now it looks like the expectations the market has around interest rate cuts and the dot plot or sort of the projection the Fed makes for themselves of how many interest rate cuts they're going to make, they're in a pretty good range with each other. So it doesn't seem like there's currently a setup for a big surprise either way.
Right.
You're pricing in the market, it's looking like 3 to 4 cuts between this year and next year.
Right.
So kind of a slow, steady, probably 0.25% cut every 3 or 4 months is what the market expects. And that's what the Fed has basically said to expect. And there has been over the last couple of years some, discrepancy where the market expects something pretty different from the Fed. So, in terms of outlook and sort of stability of return on the bond side, that seems like a setup, like you said, for solid returns from bonds and hopefully, nothing too exciting because that's the part of your portfolio that you want to help be the stabilizer,
right?
Provide some return, but to kind of dampen the volatility that you see from the stock inside your portfolio.
Well, thank you everyone for joining us. This has been a good recap of the third quarter. And if there are any questions or thoughts that you have, please feel free to contact one of us at Grand Wealth Management. Thanks.